Welcome to the Tech Today podcast. It's your host, John Mayetta. Some technical difficulties later. Here we are. Today, I want to talk about an article that we published around bank liquidity. Bank liquidity has actually been ticking up, and that is good news for credit growth. That's good news for the economy. That's good news for equity markets, good news for asset prices. Probably bad news for inflation. It probably means the cost of goods and services, let's just say it's going to apply upward pressure to the cost of goods and services. It doesn't necessarily mean that at the CPI level things will accelerate, but suffice to say it's upward pressure, not downward pressure on prices. And what we need is downward pressure. And today's article was around a measure, a Federal Reserve measure that the Fed publishes each week called ODL, other deposits and liabilities. I came across ODL probably about a year and a half ago. A former Fed economist out of the Dallas Fed, Lacey Hunt. I came across his work maybe about a year ago. His work around ODL, and so ODL is a proxy for the money supply. When the Fed drove the money supply as measured by M1 and M2 through the roof, through a combination of its monetary stimulus and by subsidizing fiscal stimulus. So because the Fed printed so much and grew the money supply so dramatically, which is what caused the inflationary mess that we're in, because anytime you increase the money supply, by definition, you cause inflation by devaluing the dollar. You're printing dollars, therefore you're diluting the value of existing dollars. So the Fed knew it was the bad guy, and so it took away the measure, the money supply measure, M1, M2. It took away the weekly reports, knowing that those reports are going to show a spike every week while they were growing the money supply and thereby causing inflation. So to make itself less of a bad guy in the public domain, the Fed took away those weekly measures and now publishes M1 and M2 on a monthly basis. So it's the data is lagging. Whereas other deposits and liabilities, that figure is published. It's a week-to-week measure, a Wednesday to Wednesday measure, and it's published on Thursday at 4:30 East Coast time after the market close. So that's where you could find ODL. And if you look at ODL, what we put in our note today, we included a 5-year chart and a 1-year chart. So the ODL figure peaked in December of 2021, came down quite sharply. At present, it stands at a level that's the highest it's been since April of 2022. So it's sort of flatlined from August until November 1 of 2023. It has been ticking up since November 1st of this year. It is now at a level that it hasn't seen since April of 2022. And if you look at the chart, it's more apparent. We have two charts in our note. It's more apparent in the 1-year chart, sort of the trend line, obviously, because it's zoomed in on the 1 year. But you'll see a spike in March of 2023, and that's when the Fed backstopped the banking industry with its bank term funding program, the BTFP, that we write about each week. So that bailout is the reason why you see ODL spike. The banks obviously were backstopped by the Fed, therefore they had the confidence to extend credit. And so, you know, if you look at the charts, as I said, it shows increased ODL, which is a good story for the economy, good story for markets. But longer term, it's bad for the economy. It's bad news for the real economy, because these things come with costs. We would not have, I posit, and it doesn't take a genius to figure out, we would not have the ODL growth. We would not have this credit growth without the benefit of the crutch, the bank, or the bailout, the bank term funding program. If the Fed yanked that program, you know, I guarantee you we would see bank credit contract. ODL would contract. And so the bank term funding program, that's due to expire March 14th, March 15th. I forget the date exactly, but mid-March of 2024. And I'm sure the Fed will extend that program. Because I believe without that program, the banking industry would contract massively and that this economy would contract significantly. I believe we would have had the hard landing that myself and other people have been talking about back in March of this year if the Fed didn't step in with that bank term funding program. And these bailouts are not a good thing. They're not a good thing because it creates massive moral hazard. The Fed essentially told these bankers, hey, no sweat, doesn't matter that you mismanaged your business. We've got your back. So what message does this send now going forward? That you don't really have to manage your assets and liabilities. That you don't really have to manage your deposits vis-a-vis withdrawals. That you don't really have to watch your cash levels as a bank CEO, as a bank operator. Right. So all that institutional knowledge that people in the banking industry have developed over hundreds and hundreds of years becomes less important. It becomes increasingly difficult for bankers who really know their business, standout bankers, to stand out. It becomes more difficult for the cream to rise to the top if the also-rans are being supported by the Fed. So it creates massive moral hazard in the banking industry, just like the fiscal stimulus did for the general population. It creates a class of people and executives and companies that become dependent on federal government, right? A socialized economy. And that's what we're looking at now. We're living in a capital market system in a broader economy that's a centrally planned economy, centrally planned capital market, where the biggest player in the broad economy and in the capital markets is the federal government and the Federal Reserve. So let's see what the trend, if this upward trend on ODL continues when the numbers come out tonight, and let's look in future weeks as the data is released, because right now it looks like it's going to be increasingly difficult for the Federal Reserve to bring inflation down if, in fact, liquidity is going in an upward direction. And by the way, if you look at the overnight reverse repo figures that the New York Federal Reserve publishes each day, that number has trend lined up since Powell's comments last week. So that's the other measure of excess liquidity in the economy, if you will, the overnight reverse repo facility, which is operated by the Fed. That number, after ticking down, more than ticking down, after coming down quite substantially since December of 2022, has started to reverse trend, and that number is going up. So we have liquidity going up all over the place, including the 10-year, which is down now around 3.8 after being up at 5 a few weeks ago. That's all for now. See you next time.